Choosing between a fixed and variable interest rate can make a big difference in your financial journey. With a few practical tips, you'll be able to make the right choice and potentially save thousands. Let's get into the details. The choice between a fixed and variable interest rate is more than just a financial technicality. It's about understanding your financial goals, your risk tolerance, and even your personality. One option offers stability and predictability, while the other might tempt you with the potential for lower payments, if you're willing to play the game. Let's break it down, no jargon, just practical tips to help you make the right decision for your situation. I will first explain the basics to ensure you understand fixed and variable interest rates and their features. Then I will walk you through the factors to consider before deciding which rate is best for your own peculiar situation, with some practical tips to aid understanding and assessment. Understanding fixed interest rates. A fixed interest rate is like a cozy blanket on a cold winter night, reliable, comforting, and always there for you. With a fixed rate, your interest rate remains the same throughout the entire term of your loan or mortgage. Whether it's 15, 20, or 30 years, you know exactly what your payments will be from day one until the loan is paid off. Understanding variable interest rates. On the flip side, variable interest rates, also known as floating interest rates, are like riding a wave, exciting, with the potential for great rewards, but also the risk of wiping out. Variable rates change based on an underlying benchmark or index. Like the prime rate set by banks or the federal funds rate, this benchmark is invariably tied to the prevailing economic conditions. Why choose a fixed interest rate? Let's talk about predictability. Think of Emily, who just bought her first home. She's meticulous about her budget, planning every penny for the next 5 years. Emily opts for a fixed interest rate because it fits her need for stability. She knows her mortgage payments will be the same every month, which helps her sleep better at night, knowing she won't be hit with any surprise hikes. Fixed rates are particularly appealing when interest rates are low. Locking in a low rate means you're protected from future rate increases, no matter what happens in the economy. Imagine buying a home when the interest rate is 3%, and then it spikes to 5%. You'd be sitting pretty, knowing your rate is locked in. The downside of a fixed interest rate. But here's the catch. What if rates go down? With a fixed rate, you're stuck with your original rate unless you refinance, which can be costly. You might also pay a premium for this peace of mind. Fixed rates generally start higher than variable rates, so you're paying for the security of knowing what your future holds. Why choose a variable interest rate? Let's meet John, a savvy investor who loves the thrill of the market. John's confident in his financial strategy and is always looking for ways to maximize his returns. He chooses a variable rate because it starts lower than the fixed rate, giving him more cash flow up front. John's betting that rates will stay low, or that he'll sell the property or refinance before rates rise significantly. Variable rates can be a great choice in a declining interest rate environment. If rates drop, your payments drop too, potentially saving you a lot of money. For instance, during periods of economic downturns or when the central bank cuts rates to stimulate the economy, variable rates can significantly lower your monthly payments. The downside of a variable interest rate. But let's be real, variable rates can be risky. If interest rates rise, so do your payments. John's gamble could backfire if rates spike, leading to higher payments than he ever expected. For someone on a tight budget, this unpredictability can be stressful. It's a bit like betting on the weather. Sometimes you win, but sometimes you're caught in a storm. The conservative investor. Sarah is a conservative investor who just retired. She's living off a fixed income and wants to avoid any financial surprises. Sarah chooses a fixed rate for her home equity loan because she values the certainty it provides. Even if interest rates skyrocket, Sarah knows her payments won't change, allowing her to manage her retirement budget without stress. The young entrepreneur. Then there's Mike, a young entrepreneur with a tech startup. Mike's business is growing rapidly, and he expects his income to increase significantly over the next few years. He opts for a variable rate mortgage, betting that he'll pay off or refinance his loan before rates rise. Mike enjoys the lower payments now, which frees up cash to invest back into his business. Fixed versus variable, practical considerations. Now that we've explored the basics, let's talk about how to decide which option is better for you. The right choice depends on a few key factors. 1. Financial stability. Are you like Emily, with a stable income and a need for predictable expenses? Or are you more like John, comfortable with a bit of risk and the potential for higher returns? If your income is steady and you value predictability, a fixed rate might be your best bet. However, if your income fluctuates or you expect it to rise over time, a variable rate might give you the flexibility you need. 2. Risk tolerance. Can you handle the possibility of your payments increasing? If the thought of higher payments keeps you up at night, stick with a fixed rate. But if you're comfortable with a bit of uncertainty and enjoy the idea of potentially saving money if rates drop, a variable rate could work for you. 3. Market conditions. What's the current interest rate environment? If rates are historically low, locking in a fixed rate could be a wise move. But if rates are high and you expect them to fall, a variable rate could save you money. 4. Loan duration. How long do you plan to keep the loan? If you're thinking long-term, a fixed rate offers security. But if you're planning to sell the property or refinance in a few years, a variable rate could give you lower payments in the short term, maximizing your cash flow. 5. Assess your financial goals. Think about your long-term financial goals. Are you planning to stay in the home or keep the loan for a long time? If so, a fixed rate might offer the stability you need. But if your situation is more fluid, like if you're planning to move or expect significant changes in your income, a variable rate might offer more flexibility. 6. Understand the terms of the loan. Read the fine print. With a variable rate, understand how often the rate can change, by how much, and what the cap is. Some loans have limits on how high the rate can go, which might make a variable rate more attractive. 7. Run the numbers. Use online calculators to compare the potential costs of fixed versus variable rates based on different scenarios. What happens if rates rise by 1%, 2%, or more? Understanding the potential financial impact can help you make an informed decision. Choosing between a fixed and variable interest rate isn't just a numbers game. It's about aligning your choice with your financial goals, your risk tolerance, and the current market conditions. Fixed rates offer stability and peace of mind, while variable rates can offer savings and flexibility, but with added risk. Before you decide, take the time to assess your situation, consider the pros and cons, and think about where you want to be in the future. Whether you're like Emily, seeking security, or like John, chasing potential savings, the right choice is the one that best fits your life. Now that you've got the inside scoop, we'd love to hear from you. What's been your experience with fixed or variable rates? Drop a comment below, and don't forget to check out our other videos, like and subscribe for more personal finance tips.